We dismiss history at our peril.
Liberty Nation Radio with Mark Angelides.
Andrew back on Liberty Nation Radio. We are continuing our conversation with Liberty Nation's economics editor, Andrew Moran. Now, Andrew, let's talk about some of the recent fears that have been stoked, the sum of all fears, and those are recession fears. The R word has made a comeback. What's happening with that?
Well, I think it all started when it came to the Federal Reserve Bank of Atlanta's GDP Now model estimate. For weeks heading into March, it had forecasted growth, at least 2 or 3% for the first quarter. Then out of nowhere, it just collapsed, and now it's forecasting 2.8% contraction for the first quarter. It's been revised up a little bit, but for the most part, still signaling a decline in GDP. Now, so this triggered a complete meltdown of one of the triggers for the complete meltdown of financial markets. You know, the Wall Street's lost about $5 trillion in value because of this sell-off that were mainly contributed to by tariffs. But the Atlanta Fed actually came out with a report on X confirming, trying to make a couple of clarifications, saying, you know, the main reason why there was a contraction in the GDP Now model estimate was because of gold imports. There was such an anomaly in a recent Bureau of Economic Analysis report that showed a huge spike, an intensification of imports of gold. Now, that should lead to, you know, wider questions of why. But so that was the main thing. So they said that if you remove that component...
Yeah, got to get there before Trump and Musk go knocking at Fort... Go searching at Fort Knox. Right?
Exactly. But if the economist here, I think is Patrick Higgins, he said if you remove that trade component of the GDP, that actually shows a positive increase in the GDP. So, of course, you know, Trump's critics, they're going to seize on that if the April first quarter report shows a decline in GDP.
Yeah, it's all about measurements as far as I can tell, because you have your GDP, and that's the sum of all things that are taking place. And then you end up with this massive gold import, and it skews things, but it actually doesn't point to the economy doing worse. The economy is actually doing, as far as I can tell, the economy appears to be doing better, or at least that's what the CPI suggests, the recent CPI suggests, doesn't it?
Wall Street would tell you that the economy is on the brink of just, you know, annihilation, considering what's going on in the Dow Jones and the NASDAQ. Yeah. Now, if you want to talk about the CPI, so the CPI showed a positive direction for inflation because it was pretty broad-based easing of inflationary pressures. I think for the shelter, that made up about at least a third of the increase of the monthly increase in inflation. Now, looking ahead to the next consumer price index report, according to the Cleveland Fed's inflation nowcasting model, it shows that the headline inflation number is going to ease to 2.5% from its current 2.8%, and core it's going to flirt between 2.9 and 3% for the first time in 4 years. So overall, inflation is heading in the positive direction. Now, there's widespread concerns that perhaps this is just a blip in the radar and it's not sustainable because of tariffs, how tariffs are going to lead to price adjustments across the board.
Okay, so let's talk about those tariffs for a second then. So, yeah, all right, just for a second. I mean, it's a very small topic. So there's a lot of uncertainty because nobody actually, I mean, we have historical models that show when tariffs are applied, certain things are going to happen. That's pretty much that prices for consumers on goods that they buy from overseas will go up. And I think that's probably a reasonable assessment. That's what the economists are warning. That's what's historically happened. But I'm wondering what that does for U.S.-based businesses.
So at least on the pricing side, so Treasury Secretary Scott Bessent, he's been saying numerous times how, you know, he doesn't expect inflation to rise across a continuum. He thinks that at the most it's going to be a one-time price adjustment. And that's what actually a lot of economic observers think is going to happen. Now, when it comes to U.S.-based businesses, there is so much concern among them. I mean, all these surveys of executives and certain industry leaders, they all say the same thing, that they're worried about the uncertainty of tariffs and they're worried about higher input costs. So so you're actually seeing some of that already transpiring even before the tariffs are in place. So you have something called Purchasing Managers pressures indexes. These are surveys of certain executives, let's say the manufacturing sector, who signal the prevailing economic direction of certain sectors. So you had, let's say, the S&P Global Insights manufacturing PMI that actually showed an acceleration of price pressures. Even selling inflation was higher. The New York Fed's Empire State Manufacturing Index also showed elevated price pressures. The Institute for Supply Management's manufacturing and services PMIs also showed a reacceleration of price pressures. So you're having all these higher costs that are starting to accumulate without even before the widespread tariffs going into effect. Because remember, the President Trump's 25% tariffs on steel aluminum, they just recently went into effect. And the reciprocal tariffs, which is scheduled for April 2nd, that's still going to take time to seep through the broader economy because tariffs do have a lag effect. One of the things that oil prices also crashed on was because of terrifying fears of
terrifying, terrifying
of a lower demand from a tariff-fueled economic downturn. So that's also one of the reasons. So I guess for President Trump, it's more of an offsetting one thing over another. So yeah, you have the tariffs, but then the tariffs are also going to lower energy costs because of fears about demand. And another thing too, lowering interest rates, because that's one of the things the administration has targeted. You see why they have President Trump and others in his administration have kept quiet about the Federal Reserve because they've seen Treasury yields decline on, once again, tariff fears, recession concerns, all those things. So the administration is achieving lower interest rates without having the Federal Reserve to do anything at all. And you're seeing this may be a different conversation, but you're seeing this seep into other credit markets. So you're seeing mortgage rates starting to come down gradually. You're seeing even auto rates coming down gradually. You're seeing higher approval rates for auto loans in an easy market. So overall, I mean, for now, without the full impact of tariffs, the economic climate is in pretty good shape. Or signaling that it's in good shape.
Let's just touch on that again, Andrew. Come back. So I want to make sure I'm understanding that. So because the Treasury yields are going down, interest rates are essentially it's a covert drop in interest rates. Is that?
Yeah, because let's look at mortgage rates, for example.
Sure.
Mortgage rates, they tend to track the 10-year yield.
Yes.
The 10-year yield was spiking from September despite the Federal Reserve cutting interest rates, and it spiked about more than 100 basis points. But since it reached a peak in mid-January, mortgage rates have been gradually coming down. So it's making things more affordable for prospective home buyers.
That's actually pretty interesting. So it would, and correct me if I'm wrong on this, but it would actually be in the administration's interest, because obviously the administration wants popular support from the country at large. So it's actually in their interest to keep the markets a little bit unstable and to keep pushing some price pressures.
Yeah, that's been a lot of theories. If you comb through X, you see a lot of theories.
I try not to too much, but.
But you see a lot of independent economists making that case that Treasury the Trump White House is trying to engineer some sort of slowdown to help bring down Treasury yields. And but it should be interesting if there's going to be a higher demand in the coming Treasury auctions for Treasury securities based on falling yields.
Andrew Moran, thanks ever so much for joining us.
Thank you for having me.
And that's it for today's edition of Liberty Nation Radio. Thank you for being here. You are appreciated. Please remember, Liberty Nation does not endorse candidates, campaigns, or legislation, and this presentation is no endorsement. Thanks for coming along.
We dismiss history at our peril.
Liberty Nation Radio with Mark Angelides.